Rose, I have a bone to pick with you.
Me?
With you. So it's been a while since we've done this format where me and you just talk it out. And what I want to get on today and talk about is the real estate market. Is it crashing? Is it going to crash? Every time I put on the news, the worst recession, biggest real estate crash ever since 2008, I go to watch YouTube because I love me some YouTube, and I can't even watch that stuff anymore because it's so much doom and gloom. Yeah. And we've seen so much downturn in the stock market recently, and even crypto, and there's a lot of things going on in the world, and I keep hearing people saying real estate is next.
Yeah.
Real estate is next. And we are starting to see a shift in the market, a decent shift in the market. So what do I tell our buyers? Don't buy, wait. What do I tell our sellers? Wait, because the value of the house is dropping. So I want to get on here, shoot a video. There's a lot of questions out there that need to be answered. Sure. That's why I'm putting you on the spot.
Okay.
How do you feel?
Good.
Let's do it?
Let's go.
Hey guys, I'm Steve.
And I'm Rose Gonzalez. We're the Gonzalez Real Estate Team, and thank you for tuning into our channel. If you're new with us, please go ahead and give a little love to that subscribe button and click on that notification button so you can be the first to know about what's going on in Northern California and what's going on with our real estate market. Ready?
You ready?
I guess so.
So I think let's kind of take it back a little bit. Last couple years, 2020, 2022, we saw such a increase in real estate value. And it was so hard to get into a home without paying well over what the asking price was. And we're starting to see a decent shift now where there's deals out there. Why? So what's happening to the market? So explain to me, I know one thing, we were able to get interest rates in the high 2s, and they shot up to the 7s at one point.
Yeah.
What created that?
So inflation, it's all about inflation right now. So basically, when we had the pandemic, the Fed rate dropped down to 0. Yeah. So that reduced interest rates for everything. Mortgage rates, to purchase cars, HELOCs, credit cards, it all just got easier.
Well, I have a question. When the Fed lowers the rates to 0, does that mean now I could get a car loan or a mortgage for 0%?
No. So that is the cost. So it's basically the banks still have to make money off interest rates. So the Fed is kind of like someone that they pay on the back end. So when the Fed rate is 0, the bank still needs a little threshold so that they can run their business, pay their employees, and run their business, right? So if it was 0% interest or the Fed reduced it to 0, well, the banks can charge 2%, 3% for car loans or whatever.
Okay, so if the Fed increases it to 2, then the banks will have to go make their money off of that, maybe do like a 4?
Yes.
Okay, I got it.
Yeah. And it's basically up to the bank how much threshold they want to do over the Fed rates.
Okay.
So what was happening, it was really cheap to borrow money. And they were doing that to stimulate the economy because of the pandemic. We had a shutdown, people stopped going out, people stopped spending. Mm-hmm. We were all home. So they were trying to stimulate the economy so that people went out, purchased things, went out to restaurants, bought cars, bought houses. So
did it work? Did they stimulate the economy?
I don't know, you tell me. So the problem that we're having is that they should have started increasing rates at a decent pace rather than what they did. Earlier this year, they just went and started increasing rate after rate after rate every couple months. So we went from an inflation rate, and it got up to in the 9%. And so they kind of panicked. And so whether they did the right thing or not, they put a lot of fear out there because people are like, what is going on? I mean, I know when we first started hearing about the rate hikes and how many they were going to do this year, we were just like, holy cow, wow. And then also the stimulus money that the government was giving, you're just giving money away for free. So that also contributed to inflation.
Sure, right.
You know, so I mean, even us, we took advantage of buying new car, getting credit cards to furnish house, and
So, as a buyer, my money is now worth less. Should I wait? I feel like there's deals out there.
there's
Should I hold off to
definitely
buy
deals out
buy a
there.
house?
So what you want to look at is basically a lot of people are on the sidelines waiting. They're waiting for housing crash to come so that they can buy a home for cheaper. Well, interest rates have gone up since January, and even though prices went down and the interest rates go up, you're actually spending more, the same or more on your mortgage payments. And over the long run, interest rates are actually going to cost you more money. Now, we follow some experts in the mortgage industry, and we've been following inflation and how the consumer price index, you know, go hand in hand with inflation rates. And so, you know, we were in the high 9% for inflation. We're down to 7.7 because the spending, the consumer price index actually went down to 0.4%.
So is it working by the Fed increasing it so much? It sounds like inflation is starting to come down.
Yeah, it is. It's starting to come down. But what we're hearing too is, you know, as we talk about home prices decelerating, we are seeing in certain areas where it just shot up so much, the home pricing is decelerating in a lot of the areas. So part of the consumer price index, 39% of it is shelter. So the only problem is that the government and the Fed, they are a little bit on a lag. So basically what we're looking at is maybe in January we will start seeing the CPI go down a little bit more because they're catching up to the deceleration of shelter, which is home prices. So they do anticipate the CPI numbers to keep going down. So how they calculate inflation is year over year CPI numbers.
Yeah.
So from, you know, let's say we're in November now, they're looking at, you know, September to October, right? And so in January, as the CPI numbers keep going down, the year over year is going to go down as well. So we've actually had experts say that we may see interest rates in the 5% again sometime next year.
So it's going to go from high twos up to the sevens, and I do hear from a lot of this doom and gloom and other people that it's going to shoot up to 10.
Honestly, I mean, no one has a crystal ball, and I've heard some people say that, you know, back in, you know, the 80s, interest rates did go up to 9, 10, almost 18.
Yeah.
We are in such a different time right now. You know, you can't compare those times with what we are today. But
what drives the rates?
So what drives rates is inflation, right? So basically how that works is the reason why rates went up when inflation was high was because the people who were lending money in the mortgage industry, like let's say I was a lender and I lent you $100,000 and I gave you an interest rate of 3% and your mortgage payments were $1,500. Well, I, as your lender, I have my own things that I need to live off of. So I have a ton of, you know, expenses myself. I had food, gas, electricity, all that stuff. But because inflation went up, all those things cost me more now. So your $1,500 does not buy me everything on my list that I need to live off of. So what am I going to do? I'm going to increase my rates so that you're paying me more money, like $1,800 instead of the $1,500, so that I can cover the cost of my goods going up. That's why mortgage rates went up, because of inflation. Now that the Fed increased the rates, people are not buying things as much as they were before. So for example, if, you know, last year you looked into buying a car and the Fed rates were still at 0, you're looking at a car and the payments would have been $500. Now if you go back to the dealership for that exact same car, but the interest rates went up, you're probably looking at an $800 to even $1,000 payment And you're going to say, well, I'm not going to buy that,
yeah.
right? So consumers aren't buying as much anymore because it's costing them money. So therefore, inflation is going to go down.
Yeah.
Deceleration of home prices, which is 39% of the CPI, inflation is going to go down. So like I said, January is kind of like the time frame they gave us.
So inflation goes down and interest rates are driven by inflation.
Yeah. Like for example,
are you predicting 10%?
Well,
are you predicting it sounds like you're predicting for it to come down.
Yeah. Well, I mean, the Fed increasing rates shows that the inflation is going down. Like I said, it's like 7.7. The CPI number for October came in a lot lower.
And
so
what did that do? Did that do anything?
It
or
did,
do we have to
actually.
Wait?
So basically, so the September number was at 0.6. So we were still at an elevated level.
Okay.
So October came and I think it was at 0.4%. And that same day,
That's good.
Yeah, that same day, interest rates went from like 7.25 to like 6.6. And we were able to renegotiate a client who was locked in at 6.6 from maybe a month ago to like a 6.25.
Right.
So we saw a huge drop in interest rate just from the October CPI numbers coming out. So like I said, in January we'll see a lot more of the CPI numbers easing because
and then from a year ago, each month drops off, right?
Yeah.
And a year ago, CPI was high.
A lot higher.
So you get rid of those old comps.
Correct. You're
and
replacing.
That helps it.
Yes.
And if CPI continues to go down, there should be a decent shift in CPI numbers,
Yep.
which is going to
help mortgage rates.
Help inflation,
Mm-hmm.
which will help mortgage rates.
Yeah.
That makes sense.
Yeah.
Should I buy a house now? It's at 6.5%, or should I wait until those rates come down?
Well, let me ask you: was it fun buying a house when there was multiple offers and you had to really fight for that house?
No, it's horrible.
Well,
it was mentally draining, and you put a lot of emotion into buying a house, especially if you have your family on the line. So yeah, it's hard.
So we all got really spoiled with the 3% interest rate, but average rates are like 5 to 7%. So people got really spoiled, and the people who were buying homes and looking at homes, they were seeing like, oh my gosh, this is like free money. So now we were at 7.25 and it slowed down the housing demand, right? Because people either couldn't afford to buy a home anymore, or they're like kind of watching what's going to happen. So when interest rates go back into the 5s, I can tell you right now, a lot more buyers are going to go out in the market and go look for that house. So whether you want to buy a house now, where you can take the time to look for the house you want, you can get seller credits, you can keep your contingencies.
Are you seeing houses with lower prices now?
Oh yeah, we're seeing price drops all the time now.
Give me an example of a quick price drop.
So what
can we look for?
So we actually had a client who bought that home in El Dorado recently. It was listed at $949. They dropped it to $899, and we actually
So we'll call it about a $50,000 price drop. Would we have gotten that same deal a year and a half ago?
Absolutely not.
What would have happened if let's say it was listed at $850? What would I got the house for? If it was listed at $850?
You probably would have had to get it for $900,000, no contingency.
So you would back then be paying more up front with a lower interest rate.
Yeah.
Now you're getting a higher interest rate with a lower cost.
Right.
And if rates go down, you could get a house at a lower cost right now while we have these deals.
Right.
And if the rates go down, you could refinance. Is that
so
worth that?
Yeah. So the joke that I have is back last year, if you thought about even for 2 seconds, if you liked that house would have been gone. Like you just had to go. So a lot of people didn't have a chance to really look for that perfect home for them. So now you can actually take the time to find the home. You can renegotiate the price. I mean, we've had a couple clients where, we went below list price, or, we may have gone list price, but we were able to ask for seller credit. Now, one thing about seller credit is there's rate buy downs. You can do a permanent buy down, but one thing that we've been hearing from the mortgage experts is that like you want to take advantage of a 2-1 buy down and refinance when rates go back down in
What's 2-1 buy down?
So the 2-1 buy down, actually now they have a 3-1 buy down, 3-2-1 buy down. So we'll keep it simple. A 2-1 buy down is where the first year of you buying a home, you actually get, so let's say the interest rate's at 7%.
Pay attention to this, guys. This is a good one right here.
So let's say interest rate's at 7%. Your first year, you're only going to be paying 5%.
Does that represent the 2?
Yes. So
2% less than what the actual current rate is?
And then the second year, it would be 6% because it would be the 1% difference.
Got it. 2-1 buy down.
Now, the thing with that is that the seller would have to cover the difference between the interest rate and the original interest rate. So between the 5 and the 7%, the seller would have to cover that on the first year. And then
hold on. Sorry. So if I'm going to buy a house, I could ask the seller to pay for my rate buy down. Mm-hmm. And that could give me a potential, obviously rates aren't 7 right now, but it would put me from a 7% to a 5% for the first year. And then the second year would go from 7 to 6.
Yep.
And that would be paid for by the seller?
The difference, the cost, yes. It's a seller credit.
Okay, so let's say after 2 years, what happens to that specific program?
So for
will
that
it go back
specific,
to the 7?
It will go to the 7. So back up. You want to make sure that you do qualify for the 7%, that you can afford it just on a worst case scenario. Like say, for example, something happened and you weren't able to refinance. You still want to make sure you make that decision based off you being able to afford that 7%.
Okay, so if rates go up to 10, like everybody says, well, you're locked in.
At 7, or whatever.
2 years from now, it's 7%. What if rates go down? What if rates go to 5%, 4%?
Yeah. So hopefully your credit's still good and you're making your payments, as long as you still qualify to refinance, because there's a lot of
and you
parts.
you have to. This is
you can actually refinance into that. If it goes into the 5% sometime next year, you can refinance into that rate. And the cool thing is that with the 2-1 buy down, the seller is paying for the difference up front, and whatever you don't use. So let's say you use up the whole 5% for the whole year, and you go into your second year, and so you're only paying the 6%. So that 1% that the seller paid for the whole year, you get that refunded, which can cover your closing costs to refinance.
Okay, 2-1 buy down. I go look for a house. I get the house is $500,000 asking price. Maybe we're able to get a deal on that. Plus, seller, because you really need to sell this house and not too much activity, I would also like you to give me seller credit to be in a 2-1 buy down program. The first year, let's say it's at 7%, we're going to get a 5-year. That's paid for by the seller. Mm-hmm. The second year would be 6%, paid for by the seller. If rates go down because inflation goes down, what we're expecting next year, then I can refinance out of the 7% that would eventually be sent back to 7% into the current better rate. And if I was able to do that within the first year, before the second year, whatever was paid up front comes back to me.
Correct.
And I use that money to refinance, so I don't have to pay for closing costs. Correct. So if you really like a house and you're able to get a lower price, mm-hmm. and it's something that's really good for you and your family.
Or not even so much a lower price. Like you can even, it has to make sense. Like you can't say, you can technically, just really depends on each scenario. So you may have to pay list price to ask for a $15,000 credit. Or if there is wiggle room, you could, ask a little bit lower. If they priced it too high, you can ask for a little bit lower with, credit. So it just really depends. But the point is that you can negotiate right now. So, it's a little bit different when a house just comes on the market versus a house that's been on the market for 60 days, 80 days. So those opportunities are still there. But the point is that you can ask for credits now. You can negotiate. So it's actually a good time to buy right now, because the other buyers who don't know about this is just sitting on the market waiting for the real estate market to crash. Right? So again, like, there's so much fear on the media about recessions and housing prices and layoffs and all these
There's
things.
so much we could talk about.
But you just have to educate yourself on the actual facts. Like, you know, things are so different from now and when it was in 2008. Like, the amount of inventory we had was so much higher in 2006, 2007, up to 2009, I believe. And we will talk about like all of these things throughout the weeks to break them down in little chunks.
Well, that's a good way to end the segment. I want to wrap this video up, but things I want to continue to ask is, we're going to be in a recession. That's got to affect the housing market, right? Well, stay tuned, because you might be surprised by that answer. There's been...
Or what about the foreclosure wave that's coming?
Huge amount of houses foreclosing now.
These are all the things the
Yes.
media is telling you, and so make sure to click on that notification button so you can see what's coming up on our videos where we address all of these things that the media is talking about.
This is also a hot topic. If you guys watch this video and you might not agree with us, please leave us a comment. What do you want us to talk about? What are your questions? What are we wrong about? That's fine too. Our goal for this channel is to just be one big community, help each other, grow together, and yeah, we're excited to hear what you guys have to say. So hope you enjoyed this video. Stay tuned. We will be creating this series and answering all your real estate questions. So again, I'm Steve.
And I'm Rose Gonzalez, and we're the Gonzalez Real Estate Team. If you haven't subscribed to our channel, make sure to give a little love to that subscribe button. And we'll catch you on the next video. Bye.
See you guys.